The 2008 financial crisis, S&P 500 down 55%, Lehman Brothers bankrupt, Bear Stearns gone, the government forced to intervene in the banking system, the worst financial crisis since 19 recovery time, approximately 4 years. By 2013, the S&P 500 was making new all-time highs. The investors who held quality assets through the panic, and especially the ones who bought during the crash, came out significantly ahead. The COVID crash of 2020, this one is remarkable. The S&P 500 fell 34% in just 33 trading days. The fastest crash in 150 years of U.S. market data. The entire world was shutting down. Borders were closing. Businesses were closing. Hospitals were overwhelmed. And the market recovered not in 25 years, not in 4 years, but in 5 months. The fastest recovery in 150 years of data. The 2022 bear market S&P 500 down 25%, triggered by the fastest interest rate hiking cycle in 40 years, persistent inflation, and recession fears. Recovery time, approximately 21 months. Another bear market, another recovery. Here is what the data tells us. The recovery timelines vary dramatically from 5 months for COVID to 25 years for 1929. The depth of the crashes varies from 25% in 2022 to 89% in 1929. But the outcome, a complete recovery and return to new all-time highs, has been consistent for 150 years without exception. That doesn't guarantee the future. Nothing in investing guarantees the future. But 150 years of consistent data across world wars, pandemics, depressions, policy errors, banking collapses, and every variety of human catastrophe is the most powerful evidence we have about what tends to happen next. Lesson 3 is the one that genuinely rewires how you look at a market crash. Because we've talked about what crashes take from investors who panic. Lesson 3 is about what crashes give, and specifically, who they give it to. Lesson #3, the wealth transfer that happens in every single crash. Lesson number 3, market crashes are not wealth destroyers, they are wealth redistributors. This is one of the most important reframes in all of investing, and most people never make it. When a market crash happens and you see your portfolio value decline, the instinct is to feel like you've lost something. And in one narrow sense, you have. The number on your screen is lower than it was yesterday. But here's what most people don't ask. Where did that wealth go? In a freely functioning market, when you sell a share for less than you paid for it, someone else bought that share at the lower price. That buyer who had cash, who had patience, who had the discipline to act when fear was screaming at everyone to run, that buyer now owns the same asset you owned at a fraction of the price. When the market recovers, they capture the upside. You locked in the loss. And theirs is not just a paper gain. It's the compounded return on having bought quality assets at distressed prices. This is the wealth transfer. It happens in every single crash. The same data that shows millions of investors panic selling at market bottoms shows, simultaneously, a smaller group of disciplined investors, institutional investors, wealthy individuals, funds with written investment policies adding to positions at those same prices. The 2008 financial crisis is the clearest modern example. Here is a fact that should stop you in your tracks. According to Reuters data published in June 2010, the year after the worst financial crisis since the Great Depression, the global population of millionaires grew 17%, from roughly 6 million to more than 10 million. Their combined wealth surged 19% to $39 trillion. $39 trillion. In the year after a crisis that wiped trillions off global markets, the wealthy got wealthier. Not because the system favored them in some abstract way, but because they had capital deployed at the bottom. They had bought the shares that panicked investors had sold. And as the recovery unfolded over the following years, their wealth compounded. Warren Buffett's famous New York Times op-ed from October 2008 titled, "Buy American," I Am was published at a moment when the S&P 500 was in free fall and the financial press was predicting systemic collapse. In it, Buffett wrote, "A simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful." And most certainly, fear is now widespread, gripping even seasoned investors. He wasn't offering comfort. He was announcing a position. He was on the buying side of the wealth transfer. The lesson: crashes are not just events to survive. For the financially prepared, they are the most significant wealth-building events in any given decade. The gap between investors who understand this and investors who don't is not a small gap. Over a lifetime of investing, it's the difference between financial dependency and financial freedom. Lesson #4. Your biggest risk is not the crash, it's what you do during it. Lesson number 4. And this one is brief, but it might be the most important sentence in this entire video. The stock market has survived the Great Depression. It has survived 2 world wars. It has survived the Cold War. It has survived oil shocks, hyperinflation, currency crises, housing collapses, banking system failures, technology bubbles, a global pandemic, and more geopolitical catastrophe than any generation should have to endure. In 150 years, it has not been permanently destroyed once. Your portfolio has never survived you. The risk to your specific financial outcome is not the crash. The crash has a documented, consistent history of ending. The risk is your behavior during the crash. The DALBAR study doesn't show that the market failed investors. It shows that investors failed themselves. The market returned what it always does over long periods. The behavior gap was the problem. In 2026, with elevated valuations and growing economic anxiety, the time to understand this is right now before the next period of volatility, before the fear is real and present and overwhelming. Because the investors who have already made this mental shift, who have already separated their emotional response from their investment decisions, they are not going to be the ones selling at the bottom. They're going to be the ones buying it right here 14 minutes in. Stay with me. We've covered 4 lessons. Fear costs more money than any bad stock pick. Every crash in 150 years has ended. Crashes transfer wealth from the panicked to the prepared. And your behavior, not the crash itself, is your biggest financial risk. Lessons 5, 6, and 7 are where this gets practical. Lesson 5 is going to show you why the best buying opportunities in investing history all felt exactly the same, like the worst possible moment to buy. Lesson 6 is what the smart money actually does, the specific behavioral strategies that have separated wealth builders from wealth losers across every market cycle. And Lesson 7 is the compound interest truth that most people intellectually understand and emotionally ignore, and how market crashes reveal exactly who has really internalized it and who hasn't. If you've been taking notes, keep going. If you haven't started, the next 10 minutes are worth writing down. Lesson #5. The best investment opportunities in history all felt like the end of the world. Lesson number 5. The greatest buying opportunities in investing history have all shared one characteristic. They felt, in the moment, like the absolute worst possible time to be buying. This is not a philosophical observation. It is a documented psychological phenomenon. The emotional environment at the bottom of a market crash is not slightly uncomfortable. It is, based on both the media coverage and the investor behavior data, characterized by maximum fear, maximum pessimism, and maximum certainty that conditions will get worse before they get better. This is what researchers call maximum pessimism, and it is, consistently, the moment closest to the bottom. Let me walk you through the emotional texture of the greatest buying opportunities in recent memory. March 9, 2009. The bottom of the 2008 financial crisis. The S&P 500 had fallen 55% from its peak. Major banks were being effectively nationalized. Unemployment was rising. The word depression was appearing in mainstream financial coverage for the first time since the 1930s. The dominant narrative was not, "This is a temporary dip." It was, "The financial system as we know it may be fundamentally broken." The investors who bought on or near March 9, 2009 and held for 5 years saw returns of approximately 200% or more. The S&P 500 went on to deliver one of the greatest sustained bull market runs in its history. March 23, 2020, the bottom of the COVID crash. The market had fallen 34% in 33 days. The entire global economy was effectively paused. There was no vaccine. There was no clear timeline for reopening. The news coverage was dominated by death tolls, overwhelmed hospitals, and projections of economic contraction. Buying the market on March 23, 2020 would have delivered approximately 75% returns in a single year. By the end of 2021, the S&P 500 was at all-time highs. The pattern is not subtle. The best entry points in market history have all been moments of maximum visibility, negative news, maximum fear, and minimum confidence in recovery. The emotional environment told investors to stay away. The data for those who looked at it said the opposite. The practical implication of this lesson is deeply uncomfortable, but it's honest. If you are waiting for conditions to feel safe before you invest during a crash, you are almost certainly going to miss the best prices. The nature of the bottom is that it doesn't feel like the bottom. It feels like the beginning of more pain. That is why so few people actually buy there, and why the wealth transfer we discussed in Lesson 3 is so reliably one-directional. The investors who profit from crashes are not the ones who predicted the bottom. They are the ones who committed to buying during the decline systematically, incrementally, with a pre-made plan, regardless of what the news was saying. That leads directly into Lesson 6, because understanding the principle is one thing. The question is, what does actually executing this look like? What are the specific behaviors that distinguish crash wealth builders from crash wealth losers? The answer is more mundane than you'd expect, and that's exactly why it works. Lesson #6. What the smart money actually does during a crash. The behaviors that build generational wealth. Lesson number 6. What do the investors who build wealth through crashes actually do differently? Because it's easy to say be greedy when others are fearful. Warren Buffett said it. The data supports it. But the execution, the actual behavioral mechanics of how you do that when every instinct and every news headline is telling you to run, that's what this lesson is about. Behavior 1. They write the plan before the crash, not during it. The investors who consistently buy at crash prices are not making that decision in real time, under emotional pressure, while markets are falling. They have already decided when conditions are calm, when their reasoning is clear what they will do when certain conditions are met. If the market falls 20%, I will deploy X dollars. If it falls 30%, I will deploy Y dollars. If it falls 40%, I will deploy Z dollars. The decision is made once, in advance. The execution is mechanical. This is not complicated. It is almost uncomfortably simple. But the reason most investors don't do it is because most investors believe until it's too late that they will be calm enough to reason clearly during a crash. DALBAR's 30-year data says they won't be. The smart money makes its decisions before the fear arrives. Behavior 2. They separate their holdings into time horizons. The most psychologically damaging mistake during a crash is watching money you might need in the next year fall in value. The solution is not to have that money in the stock market in the first place. Investors who build wealth through crashes hold their emergency fund, their 6 to 12 months of living expenses, in cash or equivalent. Their short-term goals money they'll need within 3 years in lower-risk instruments. Their long-term wealth money they genuinely will not need for 5 or more years in equity markets. This structure means that when a crash happens, the falling portfolio is money that has time to recover. It's not rent money. It's not emergency fund money. It's not the money that pays for school next year. That psychological clarity, that clear-eyed understanding that the falling number is long-term money is what allows disciplined investors to hold and even add when fear says run. Behavior 3. They consume less financial news during crashes. This sounds almost counterintuitive. Surely you should be more informed during a crisis. But the DALBAR data shows that frequent checking of portfolio values and constant consumption of financial media during down markets is statistically correlated with worse investment outcomes, more buying and selling at the wrong times. The smart money during a crash is doing less, not more. They are executing their pre-written plan. They are not watching CNBC for 8 hours and making reactive decisions based on the latest headline. Behavior 4. They focus on the business, not the price. This is Warren Buffett's core principle, stated 100 different ways across 60 years. When you own shares in a quality company, one with durable competitive advantages, strong cash flows, and a resilient business model, a falling stock price doesn't mean the business has become less valuable. It means other investors are willing to sell their ownership at a lower price than they were yesterday. The business's earnings power, its market position, its management team, none of that changes because the stock price fell. The investor who keeps their attention on what they actually own rather than its current market price can hold through periods that others can't. Lesson #7. The most powerful force in finance requires something most people won't give it: time. Lesson number 7. Compound interest. What Albert Einstein allegedly called the eighth wonder of the world is the single most powerful wealth-building force in the history of finance. It is also the force most consistently destroyed by investor behavior during market crashes. The math is not subtle. The S&P 500 has averaged approximately 10.5% annual returns, including dividends over 100 years of data through every crash, every war, every recession, every panic we've already discussed. At 10.5% annually, a $10,000 investment held for 10 years grows to approximately $27,000. Held for 20 years, approximately $73,000. Held for 30 years, approximately $200,000. Held for 40 years, approximately $540,000 to $600,000. This is not speculation. This is 100 years of documented market returns, compounded through every catastrophe we've discussed. It is the most reliable long-term wealth-building data set in the history of investing. But here is what market crashes reveal, and this is the painful truth. The compound curve only works for people who stay on it. Every time an investor sells during a crash and waits to get back in when it feels safer, they are, in effect, stepping off the compound curve. They lock in their loss at current prices. They sit in cash while the market recovers. And then often they get back in near the new highs, FOMO pulling them back in at prices higher than where they sold. They have, with those two transactions, bought high and sold low. The exact opposite of what compound investing requires. A study measuring the returns of investors who missed just the 10 best days in the stock market over a 20-year period found that their returns were cut by more than half compared to investors who simply held 10 days out of roughly 5,000 trading days. Miss the 10 best days, which often happen during crash recoveries, which is exactly when fear-driven investors have left the market, and your 20-year return is less than half of what it could have been. This is why market crashes are the ultimate test of whether compound investing will work for you. Not because the math is complicated. The math is the simplest thing in finance. It's the behavior that's hard. Compound interest requires time. Market crashes are the events that make time feel impossible. The investors who build generational wealth through market cycles are not smarter. They are not lucky. They are not accessing information that other investors don't have. They have made one decision, one commitment that most investors have not. They have decided that their wealth-building process is a long-term process. And they have built the psychological, structural, and practical guardrails to hold that commitment when every instinct and every headline is testing it. The synthesis, what all 7 lessons have in common, the thread that changes everything. 7 lessons. Let me pull the thread that connects all of them. Lesson 1 told you that fear costs more money than any bad stock pick. Lesson 2 showed you that every crash in 150 years has ended. Lesson 3 revealed that crashes don't destroy wealth, they transfer it. Lesson 4 told you that your behavior, not the crash itself, is your primary risk. Lesson 5 showed you that the best opportunities look, in the moment, like the worst possible time to act. Lesson 6 gave you the actual behavioral mechanics of how disciplined investors execute. And Lesson 7 showed you that the compound curve is the most powerful, wealth-building tool in existence, but it only works for people who stay on it. The thread connecting all 7 is this. The stock market over meaningful time periods rewards capital and punishes emotion. Not because the market is designed to punish people who feel things, but because the market is a mechanism that aggregates the collective behavior of millions of investors. When millions of investors make fear-driven decisions simultaneously, prices fall below their intrinsic value. When millions of investors make greed-driven decisions simultaneously, prices rise above their intrinsic value. The investor who can maintain a clear-eyed, data-driven approach to both situations, buying when prices are below value and holding through volatility, is the investor who captures the long-run return. Right now, in March 2026, with 72% of Americans already feeling negative about the economy, with valuations elevated and economic uncertainty rising, these lessons are not history. They are the operating manual for what is coming. The crash may come. It may be modest. It may be severe. History says it will come eventually. And when it does, the investors who have internalized these 7 lessons will experience it differently. Not without fear. Fear is human. Not without stress, but with a framework that converts that fear into disciplined, strategic action instead of the wealth-destroying panic that the DALBAR data has been documenting for 30 years. That is the real lesson of every market crash. Not the market goes up, though it does. Not buy the dip, though timing matters. The real lesson is the people who win financially are the people who have made their decisions before the fear arrives, and they execute them when it does. Let me leave you with this. Every single investor who has ever panicked during a market crash has told themselves a version of the same story. This time is different. This one won't recover. I'll get back in when it's safe. And every time, in 150 years without exception, the market eventually made those fears look like noise on a graph that went somewhere beautiful over time. You now have 7 lessons from 150 years of market history: the fear data, the recovery data, the wealth transfer data, the behavior science, the opportunity evidence, the execution framework, and the compound math. That is the most complete toolkit any investor can have before the next storm arrives. What you do with it is yours to decide. If this gave you genuine clarity, hit that like button. It costs you nothing, and it tells the algorithm this content is worth showing to the people who need it. Subscribe if you're serious about understanding money at this level. I publish every week, and everything I create is built around one goal: helping you build real wealth through real knowledge. Drop your biggest takeaway in the comments or tell me which lesson hit you the hardest. I read every comment. I respond to every one. The wealth is built in the moments when everyone else is running the other way. I'll see you in the next one.